Hello and welcome once again to 5 Minute Friday. And this week, I'm very, very, very happy to be joined once again by Stephen Seidler from CMG Loans. Welcome, Stephen.
How are you doing today, Tricia?
I am doing awesome. I'm so glad that you're so up to coming on again, and it's like hasn't put you off or anything like that. And it's
Love
great to
it.
have you again.
And this time we'll keep it to 5 minutes.
Oh, okay, that's a challenge. Let's see. I don't think that's happened for anyone, but let's see.
Okay.
So, Stephen, I really appreciate you coming on, especially with the interest rate cuts, the Fed cuts. Everybody's excited. Everybody's talking about how, go out and buy your home now because, the interest rates have gone down. Everything is awesome. I'd love your input on that. How are you seeing the market?
Wonderful. Thank you. Well, yes, as many people know that on September 18th, which was about 3 weeks ago, the Fed, for the first time in about 4 years, cut short-term overnight Fed funds interest rate that they're called, which is not mortgage rates, as most people think. Oh, they lowered mortgage rates. No, there's no direct line between the two. The Fed, when they lower rates, is just the short-term rates, which means what banks can borrow from each other, the government from. Ironically, no, mortgage rates have not gone down since the Fed cut. And that is not that uncommon, as I'm about to show you. I'm actually like to start to show you, Tricia, if you can share the screen a little bit.
Yeah, I'm okay. First of all,
Yes.
before you share the screen, um,
That's surprising
let's
to hear
rewind a
that the
bit.
mortgage rates are
What do you
going
mean?
up, not down. Yes.
Yeah.
So mortgage rates are related to the bond market very directly. And what I'd like to show you is, if you can see where my cursor is, at the bottom of the screen is September 16th, right around here. And if we go up to right about here, red is bad and green is good. So
Okay, I
moving
can't see
forward.
your cursor.
Oh, you can't see the cursor. So let's see how I can do this.
Just
If I
tell me
just
where to look.
zoom,
Okay.
let's see.
Oh,
How
okay.
about
Yeah,
highlighting it right here? Now you can see
perfect.
it. Okay. So on September 18th, right around here, is when the Fed lowered short-term rates. And you can see that pretty much every single day, and in particular last week, how red it is. And the little lock signs are when we're getting market tags to say lock, the market is eroding. And you can see that even up until today, we've had virtually almost all red days since the Fed lowered the interest rates. And that means that the bond market has gotten worse for you and me, meaning that mortgage rates have gone up. Now, that is not uncommon, as we will see from this historical chart.
No, hold the
Yes.
phone there.
Okay.
Hold the phone. How come everybody is saying that the interest rates have gone down, and you're saying no, actually they haven't? What's the
Where's the
difference?
disconnect? It's mainly the media, frankly, keeping in mind that a lot of this happens in the past. So when something happens and then they start to report it, time is still moving along. So if we get 1 or 2 good days of interest rates, and in fact, let me actually go back to that screen. And if we look at September 18th exactly, we actually did have one little good day of interest rate, and it didn't get so bad right after that. It kind of stayed steady. Everyone expected the interest rates to fall. All of the advertising came out and said mortgage rates are falling and falling. But very shortly after those few days, in reality, it started to turn red pretty bad and pretty quickly. And we see how far down it's gone. And if I actually use this comparison, that means it's all the way back from August or July, actually, that it took us all the gains we had from July, where things incrementally, slowly got better here in the green. And now it's really quickly gotten worse, if you can see that.
So
So
why did that happen? Well, I mean, if I was going for a mortgage today, what interest rate would I be getting?
well, that's a kind of a loaded question because there's so many different dynamics for each. Is it a purchase, or is it a refinance? Is it a great borrower, a 580 credit score
It's a
borrower? I like
purchase.
to tell people that the very, very best borrowers are getting rates somewhere in the low to mid sixes right now. And while we've seen advertisements in the high fives that have probably gone away over this last couple of weeks because of the red, in the beginning, we started to see some advertisements in the high fives. Those were generally either best borrowers or you had to pay a point to get there. And you don't want to pay a point in a lowering interest rate market where you're likely going to refinance in 6 to 12 months. So a lot of media and advertisement, that's what our country is good at. That's what our world is good at. They only report the flash, the sizzle, and even if it's incorrect. And I think we all agree that even with serious political topics or war and death that's going around in the world, our media is not always the most accurate. So that's the simple reason why. But in reality, what's happened is the bond market is decreed to deteriorate. And the reason for that is partially because our economy is still a little too strong. In that, the Fed has been raising rates to slow our economy to help inflation. Let's look at this from the most simplest terms. The Fed raised rates over these last 4 years because inflation was too high. We all know that pricing after COVID on our food, which is still too high, our gas, which is still pretty high, all of those things were pretty high. Well, the Fed raised rates to lower inflation and slow down the economy. They've done that, but our economy is so resilient that these red marks here right last week came because the jobs report came out way too strong, double the jobs that people were expecting, basically.
So the economy is good.
The economy is pretty good. And what the government is saying, what the Fed in particular, who tries to control our monetary policy by either raising rates or lowering rates, is basically saying we're going for a soft landing. We raised interest rates to slow down the economy, but we're not trying to crash the economy. We want to give it a soft landing is what it's called. And a soft landing basically means kind of what we're in. It's slowing, but it's not crashing. Jobs are still good. CPI, the Consumer Price Index reports, were coming out strong. There's a couple revisions that are happening that are weakening it. This is how we want it. We want a gentle movement down. We don't want something that's very fast and flash in the pan, because that's often hurts more than helps. So what's interesting is this is very normal. And I'd like to show that historically speaking, specifically after a rate cut, do you see my cursor when I do this now?
I do.
Okay, great. So going all the way back 40 years, we see what the first rate cut amount was when they started to cut, what the start of the 10-year bond yield was. That was kind of what we were looking at. And then how much it spiked in the short term thereafter. So we can see that they started way back 40 years ago. They did a 0.25% cut. The yield was at 12.25. It actually went up 0.31 after that. In 87, they raised it by, they cut it by a half. Here's where it was at. It spiked by 0.3. And every time there was a reduction in rates throughout the years, 89, 95, 2001, 2007, you can see a corresponding spike, except during 2019. It's the one outlier. And then continuing 2020, there was a spike. And now we see after our September 18, 2024, there's a 0.36 spike, just like the end. However, we also see that after the relative percent of decline after is right here on this far right screen. We all did see a 43% decline, which is good for us in the mid to long run. And here, 9, 38, 33, 36, 44, 31, 49, question mark, where we will see our rates go down to. We don't know yet. We'll see after the next cut is made, etc. So you can see that in the short run, rates always go up in the short run, but then they always decline after. And when I say always, there was that 2019 outlier. Does that all make sense, first of all?
Yeah, it does. But I have a couple of questions, if that's okay.
Yeah.
And I hope I'm speaking for every layman out there right now. So, okay, I see it was cut by 0.5% and it spiked by 0.36. It's still lower because it's under the 0.5, right? It's still lower.
Actually, these are, yes, that's a good observation, but we're talking about, in essence, two different things. This brings me back to what I said in the beginning about the Fed's overnight short funds rate, the Fed overnight lending rate compared to mortgage rates. They're not direct connected. So what we're talking about is the cut of the overnight Fed's rate, which is what they did. But this next column is the bond yield. and the bond yield is what's more relatable to the mortgage interest rates directly. So the bond yields are what are directly related to the mortgage rates. These two things can't be added or subtracted, the 0.5 and the 0.36, because it's an apple and an orange. It just happens to be close that you're saying, oh, but wait, it was a cut by 0.5. It only went up by 0.36, but they're two different things. The cut of 0.5 had remember, that was just the short-term rates.
Yeah,
that had
that's
nothing to do with the mortgage rates. The bond yields is what happened in the mortgage rate. So if we say that after the short-term rates were cut by a half and the long-term rates went up by 0.36, you can actually almost say, if you were going to combine those two together, that it was a 0.86 difference, because one went up and one went down. So it's actually increased that difference, if that makes sense. You can't add those two together because they're not in the same.
Okay. And when you say the relative decline and the cycle low and drop from first cut, what time period are we looking at there where we see these?
These time periods, that's a great question. And I don't want to hem and haw too much on the video, so I don't know off the top of my head without searching for it. But it was the relative percentage decline, probably set 6 months or a 12-month period after the rate. So that's a really good, my guess is it was probably no less than 3 to 6 months. Maybe this is after 6 to 12 months.
Okay, yeah, I was thinking it's because we are expecting it to really take about 6 months for it to really affect the market, right?
Yes, and we're hoping actually that the turn could be happening right now. If I go back to the tab here, right even today where it's green, if I go to, let's change this to a 1 month so that we can see a little bit closer. So we can see September 18th is when the rate cut happened, the short-term rate cut. And again, remember, red is bad, where the mortgage-backed securities were slowly getting worse. Slowly, we thought things were temporary. And then as of October 3rd, you can see it just plummet. This is bad, mortgage rates going up. Just today, we're seeing some green outliers again that we think maybe, because there's a lot of complicated, all of these lines in the charts, there's people way higher than my pay grade that are analyzing to the millionth of the percentage. It says we might be bouncing off of this line right here and now start our rates back up, slow climb back into the green, which means good mortgage rates for you and me.
Okay, so that is the silver lining. We are seeing it getting positive again. So what's your advice to buyers right now? Are you saying hold on, it's going to get better, or just if you love the house, get it and refinance?
But absolutely. And it's been for 2 years. Any professional in the mortgage or the real estate world has mostly been saying, since you date the rate and buy the house, buy the house now and just refinance the rate when it comes down. We had people that bought 1 year ago at 8%. Best borrowers, 20% down, 800 credit, bought at 8%. They've since refinanced 1 or 2 times since then already. The people that are buying now, even if it's because of this slight peak where maybe rates you could have bought before the rate change, maybe you could have gotten 6.125%. Now you're at 6.5%, for example. It doesn't mean don't buy now. It means a little bad luck on timing. Don't worry. In 6 months, you'll be able to get down to 6% or 5.5% or whatever the numbers where the trends are. Nobody really knows. Don't let them everyone quote you where they think the long-term mortgage rates are going and how quickly, but it is very likely that next year we'll be into the 5s, maybe even as soon as the end of this year that we'll start to see the high 5s for best borrowers.
Okay, I'm going to get you to say that again. That's the bit of positive news that we all want, right?
News. So absolutely. We are on track to getting into the high 5s for rates, probably by the end of this year, but certainly by Q1 of next year.
Okay, great.
There we go. We'll see. We'll look back 3 months from now and see if that's right.
You'll be back on going like, okay, so remember I said this.
Yeah. Now, that wasn't quite 5 minutes, Tricia, but it was a lot faster than our last one. So any other questions, do you think?
I think it's pretty close, Stephen. It's 5 minutes. I've never had anyone stick to 5 minutes, but thank you again. I really appreciate that. And I know for me and for a lot of people out there, when they start looking at graphs, that their minds melt. But I think you
Yes.
explained it absolutely brilliantly.
Great.
And I
Thank you,
appreciate
Tricia.
and I appreciate that, you know, you're letting us know exactly what's happening. It's not quite what people were saying, but
Yes.
the positive outcome is there on the horizon.
Exactly. Soon. Just be a little patient and we're almost there.
Okay. And I'm just putting out Stephen's phone number and, oh, what did I do there?
Nope, but that works. That's
That
good.
works.
That stuff is fine there too.
Okay. And his number there if you want to give him a shout.
Yes.
Stephen is a
Happy to
fantastic
help.
person to have a chat to. He makes things very easy to understand, even when they're like blowing your mind at the same time. Stephen, thanks again for coming
Thanks,
on.
Tricia, for
Always
doing
fun.
this and spreading the knowledge.
Always. Take care.
Take care. Bye-bye.